Everyone, 2021, it was a record year for private equity as large inflows and high leverage led to a PE shopping spree. But now it's taking longer to fundraise as funds compete for investor dollars in the depressed environment. William Blair's head of equity capital, Steve Maletzky, joins us now to discuss. Steve, okay, things largely different between 2021 and 2022. This large delta in deal making that we've seen in companies that have been able to go public. If you were to summarize it to one thing, what is the leading cause?
Well, I think the leading cause, well, first off, good morning and thanks for having me. But I think that the leading cause is we saw a massive oversupply of activity last year. You had 400 traditional IPOs along with 600 SPACs go public. It was a record year, both in terms of volume and total proceeds raised in the IPO market. And risk appetite was significantly high, and you had those IPOs transacting at elevated multiples. Unfortunately, a lot of those companies have not performed and stocks have declined. And IPO markets and small and mid-cap high growth companies tend to perform well in low volatility environments. And right now we have a lot of uncertainty on a geopolitical front as well as on a macroeconomic front as investors are trying to sort through the uncertainty around Fed policy and which direction we're going from an inflation and a recessionary perspective.
This pullback in offerings is also very much on our minds as we look through big bank earnings, right? Because we are seeing revenue from these areas fall. How long do these cycles typically last? And kind of when might you predict an upturn here?
Sure. Well, I think we're not seeing a downturn across the board, across all deal making. I think what's interesting, if you look at the Goldman numbers this morning, while they beat consensus, investment banking revenue was down around 40%, but M&A was only down 5%. And that's very similar to what we're seeing at our firm and in the markets that we operate in is financing and on the equity and the debt front, clearly seeing meaningful amounts of volatility, but a big lag in the multiple compression or the slowing in M&A as well as in private capital. And so we are seeing a significant amount of success still in the M&A market. Where it's private equity to private equity transactions and seeing strategics also get more aggressive as public equity valuations have declined and capital has become scarce. And that's an opportunity for buyers to step in and support companies or acquire companies that had otherwise planned to go public or raise capital in the public markets.
Steve, look, despite the slowdown in deal making, conversations are still happening. Companies are still running numbers on other companies. They're trying to assess what might be attractive down the line. So when that deal floodgate does open, what sectors do you think will be some of the hottest?
I think we're still in an environment where there's a lot of appetite for growth. And when I think about growth, we're seeing a lot of appetite in tech broadly, specifically on the software side. Healthcare, seeing a significant amount of activity in the life sciences category, where there's been tremendous growth and tremendous returns earned. Right now, those are some of the weaker categories. I think those are areas you're going to see a big run when deal markets do open up. And I would say on the consumer side, there's a lot of pent-up demand and pent-up interest from the restaurant community and restaurant companies that are seeking capital and are likely to be floated into the public markets.
Thanks so much, Steve. Good to get some time with you and get a little bit of a barometer on what's going on out there. Steve Maletzky, William Blair, Managing Director and Head of Equity Capital. Thank you.